Hello guys and welcome back to our YouTube channel. In this video we are talking about Master the 6 Basic Rules of Investing by Robert Kiyosaki. Before we continue our video, make sure to subscribe to our channel and hit the bell icon for more videos. So let's get started. The process of moving from being an employee or self-employed to a business owner or sophisticated investor is a bit like that of a caterpillar turning into a beautiful butterfly. It takes time and often requires a total transformation in mindset and behavior. One of these behavior changes is understanding what to do when you have more money suddenly at your disposal. Whether it's from an inheritance, a raise or bonus, or some other source, the temptation for those on the left side of the quadrant can be to, at best, follow conventional advice about money or, at worst, to spend it on liabilities like cars or vacations. Such conventional advice could be to increase your contributions to your 401k, or to continue to live below your means. The 6 Basic Rules of Investing. Number 1. Adjust your money mindset. In Rich Dad's Guide to Investing, what the rich invest in, that the poor and the middle class do not. It deals with the importance of adjusting your mindset from that of the poor and the middle class to that of the rich. The poor and the middle class teach their kids that, go to school, get a good job, work hard and save money. That will make you rich. The rich teach their kids that, learn how money works, create good jobs, have money work hard for you, and invest in cash-flowing assets. That will make you rich. One of the fundamental errors of the poor and middle-class mindset is that they think you can get rich working for a salary. But the reality is that it's very hard to do because of the way the tax code is structured. Because the government takes taxes out of a paycheck before an employee even sees it, they are always at a disadvantage when it comes to business and investing than that of a business owner. Why? Business owners can invest their money pre-tax. Not only does this give them more money to work with, but it also reduces their total taxable income, which means they often pay less in taxes than the poor and the middle class. This is a rich mindset. Number 2. Know what kind of income you're working for. Most people think only of making money at a good job. They don't realize that there are different kinds of income. There are 3 kinds of income. Ordinary earned income. This is the type of income that most people think of when they talk about making money. This is the income of the working 9-to-5 set. It is generally earned from a job via a paycheck. It's the highest taxed income, and thus, the hardest to build wealth with due to the government taking money out of your paycheck before you even get it, and the fact that you're trading time for money. Portfolio income. Most high-paid employees also have some form of portfolio income, usually in the form of a 401k, and various paper assets like mutual funds managed by a financial advisor. Portfolio income is generally derived from paper assets, such as stocks, bonds, and mutual funds. It is the second highest taxed income, and is moderately hard to build wealth with due to low returns. Passive income. People with a high financial IQ have an investment strategy that aims to create passive income. Passive income is generally derived from real estate, royalties, and business distributions. If you receive rent from a property, that is passive income. In short, it is income that comes to you whether you are working or not. It is the lowest taxed income, with many tax benefits, and is the easiest income to build wealth with thanks to its combination of low taxes and potentially infinite returns. Number 3. Convert ordinary income into passive income. Most people start their life out by making ordinary earned income as an employee. The path to building wealth then starts with understanding that there are other types of income, and then converting your earned income into the other types of income as efficiently as possible. To illustrate this, Rich Dad drew a simple diagram. That, in a nutshell, said Rich Dad, is all an investor is supposed to do. It's as basic as it can get. Number 4. The investor is the asset or liability. Many people think investing is risky. The reality, however, is that it's the investor who is risky. The investor is the asset or liability. I have seen investors lose money when everyone else is making it, said Rich Dad. In fact, a good investor loves to follow behind a risky investor because that is where the real investment bargains can be found. What this means is that your financial knowledge can either be an asset or a liability. If you have a low financial IQ, but decide to dive into big-time investments anyway, you'll make a lot of mistakes that investors with a high financial IQ will capitalize on. If you want to move from being a risky investor to a good investor, first invest in your financial education. As part of your education, because nothing beats real-life experience, start small with your investments, learn from your mistakes, and then make bigger and bigger investments. Number 5. Good deals attract money. One of my big concerns as a beginning investor was how I would raise money if I found a good deal. Rich Dad reminded me that my job was to stay focused on the opportunities in front of me, to be prepared. If you are prepared, which means you have education and experience, said Rich Dad, and you find a good deal, the money will find you, or you will find the money. Rich Dad's point was that getting the money was the easy part. The hard part was finding a great deal that attracted the money, which is why so many people are ready to give money to a good investor. Number 6. Learn to evaluate risk and reward. As you become a successful investor, you must learn to evaluate risk and reward. Rich Dad used the example of a nephew building a burger stand. If you had a nephew with an idea for a burger stand, and he needed $25,000, would that be a good investment? No, I answered. There is too much risk for too little reward. Very good, said Rich Dad, but what if I told you that this nephew has been working for a major burger chain for the past 15 years, has been a vice president of every important aspect in the business, and is ready to go out on his own and build a worldwide burger chain? And what if you could buy 5% of the company with a mere $25,000? Would that be of interest to you? Yes, I said. Definitely, because there is more reward for the same amount of risk. Learning and mastering the rules of investing takes a lifelong investment in financial education. But these basics will get you started. Where you go from here is up to you. Hope you guys understand the 6 basic rules of investing. Make sure to subscribe to our channel and hit the bell icon for more videos. Thanks for watching and have a wonderful day.